Hello, everyone, and welcome to the third quarter Heritage Wealth Advisors market update. My name is Jay Jordan. I'm the Chief Investment Officer at Heritage, and I'm joined today by my colleagues Carrie Baronian and Steve Henderson. Our goal for this call is to give you an update on our current views around the markets and around the overall economy, and then how we're currently positioning client portfolios. So why don't we get started?
Yeah. Okay, Jay, here's a question for you then. So 3 months ago, we were talking about higher rates and higher inflation, and things felt pretty uncomfortable. And I think all those things are true, but yet the market is really started to rally here in the last few months. And I think the S&P is up close to 20% year to date. And so I think a question we need to ask ourselves is all the bad news behind us? Is this over? Is the Fed not going to be raising rates, and is inflation not a problem anymore?
Yeah, and it's a great question, and the question of what has changed, and look, this is the most challenging time to be an investor when markets begin to move in an incongruous way relative to the underlying fundamentals within the economy. This is the period of time where, as an investor, it becomes particularly uncomfortable to continue to implement and employ a process and discipline. But I can tell you that in my experience, what we found is that over time, the biggest mistakes that investors make is when they abandon a process and a philosophy and a discipline based on short-term market moves, which in this case, I would argue are primarily sentiment oriented. And I picked up the paper this morning, and the headline within the Wall Street Journal is "Investors Feel Bold Again, Go Speculative." And I think that's a pretty good encapsulation of what's going on in the market right now. If you look at current market performance, you mentioned that the market's up 20%, but when you peel back the onion on that 20%, as we've talked about, the vast majority of that return has come from 7 mega cap technology names with some level of exposure to artificial intelligence. It's masking some weakness within the overall economy, and it's masking some weakness within the overall markets. But I think that when we take a step back and we think about what we are trying to accomplish for our clients, we are going to continue to evaluate portfolios and evaluate asset classes, looking at expected returns from a particular point in time at a particular level of valuation, with an eye towards weighing those expected returns versus underlying risk within the markets and within the economy.
Yeah. So on a go-forward basis, how would you articulate our view? It sounds like we're still a little defensive.
Yeah, we are, and I don't think that our views have changed that much, and I think that's important because, again, what we see that is different is primarily sentiment oriented. And when you look at the underlying economy, our challenge is this disconnect between what appears to be going on in the underlying economy and where expectations for an acceleration in the future lie. And looking at the economy, our base case is that the lagged impact of rising interest rates over the last 18 months, coupled with the lack of credit availability, particularly as banks have reined in lending over the course of the last 12 months. You layer that on to what has been surprising, honestly, is the resiliency of the consumer. And that's been based on a couple different dynamics. One is that unemployment remains very low, and wages have been stronger. But two has been this collection of excess savings that occurred through the pandemic, which has continued to bolster the consumer over the course of the last 24 months. Now, what concerns us is that when you look at that excess savings, it's now diminishing. We've now worked through about 2/3 of that excess savings. And so when you think about the consumer, the resiliency of the consumer, that's becoming more challenged on a go-forward basis. And then finally, continued weakness in the global economy. When you pull all of those together and you think about the direction of the economy and the leading indicators of the economy, which continue to weaken, and then you match that up against expectations for an acceleration in earnings growth in the back half of this year into 2024, there's an incongruity that we simply can't match. And so, Carrie, maybe that's a good opportunity to maybe flip to how those views affect the way we're positioned.
Yeah, would say philosophically, we absolutely remain convicted in our approach, which is to build and manage client portfolios that are capable of holding up better when markets are moving lower, as well as participating when markets are moving higher. We've seen historically this is the key to generating superior risk-adjusted returns over the long run. From an asset allocation perspective, we continue to manage equity allocations below long-term targets. This is in part because of the backdrop you just laid out, Jay. as well as what it means that we're now living in a world where the risk-free rate is 5%. All else equal, as we move further away from zero interest rates, our clients shouldn't need to stretch as far on the risk spectrum to meet their financial plan. Focusing in on equity allocations, we continue to own our concentrated leaders as the core. There, our strategy hasn't changed. We want to purchase high quality businesses at reasonable valuations and hold them for long periods of time, allowing the power of compounding to work. This includes owning several of the mega cap technology stocks that have been the primary beneficiaries of the AI driven rally this year, specifically the ones that we truly believe are great businesses and meet our criteria for good long term investments. We believe we've sized them appropriately in the portfolio. We're making room for other businesses we believe are exceptional and possess attractive long-term return potential that are in other really important segments of the economy. For example, healthcare, consumer spending, industrials, and financial services. Turning to fixed income allocations, we continue to maintain balanced exposure to investment-grade core bonds, Treasury inflation-protected securities, and traditional nominal treasuries. So overall, still taking relatively little credit risk. And then from a duration perspective, continuing to prioritize short-term securities, given that they continue to offer the highest yield on the yield curve. Outside of traditional stocks and bonds, we continue to hold a position in gold as a diversifier and hedge against ongoing policy uncertainty. And then we continue to build an allocation to private investments in client portfolios for clients who have the ability and willingness to embrace the illiquidity characteristics of those markets. So Steve, maybe that's a natural segue to you to provide an update on the private markets and our Heritage Private Fund.
Yeah, sure. So look, we think a lot about risk with this portfolio as well. We look at things on a risk-adjusted basis, and I'd say the biggest thing that's going on in the private markets today is valuations, and it generally lags the public markets by a quarter or two. So there's still some things have been adjusted, some things are still adjusting, and so you have to be careful there. We still find opportunities with the private equity space, specifically the lower middle market private equity space, where you can buy a business at a reasonable price and have reasonable expectations of growing the business and exiting the business at a higher multiple. So those opportunities are there today, and we're taking advantage of them. You flip over to, say, the venture side, where it's choppier for sure, particularly with the later stage venture stuff, where the valuations are sort of sticky, and it's painful for the managers and the underlying businesses to lower their valuations. So they're still going to do it. It just takes some time, and that's where the venture space is. On the credit side, you hear a lot about private credit as an opportunity. It is a good opportunity. You have to be careful. You have to, the valuations matter there as well. And the banks, as Jay said, they're not lending the way they used to. The traditional banks, so the shadow banking industry is filling that void and capitalizing these businesses. So private credit is attractive. Lower middle market buyout equity funds are attractive. There's pockets of opportunity in the real estate space, specifically the multifamily and industrial sectors. Energy still needs some capital. Venture, a little cautious. So risk is a big word to us, and we think about it in the public markets and the private markets, but we are building, I think, a fantastic portfolio. So that's where we are in the private space.
Great. And so I think if we wrap it all together and think about where we are today, our view remains that there remain headwinds within the broader economy that aren't necessarily being reflected in the markets currently. And importantly, as Carrie mentioned, in an environment where the risk-free rate is now roughly 5%, where you have the ability to earn, where you don't need to stretch for returns within the market, we're going to, and given the challenges that we see within the market, we're going to continue to be focused on managing risk in client portfolios with an eye towards participating in opportunities as they present themselves. So I want to thank Carrie and Steve both for joining me this morning, and thank all of you for joining us. And we look forward to speaking with each of you individually about your specific portfolios.